Recent data from the jobs market in the U.S. indicated potentially signs of slowing down. So in August, non-farm payrolls increased by 142,000, lower than the monthly average of 202,000. The unemployment rate slightly decreased to 4.2%, down from 4.3% in July. And while job growth continues in sectors like construction and healthcare, overall hiring activity has decelerated, contributing to concerns about a gradual weakening of the labor market. So, how significant is this weakening, and what's next for the unemployment rate and the strength of the jobs market overall? And how will the Fed react to recent data? We're talking about this with the next guest, Anna Wong. She is the chief U.S. Economist for Bloomberg Economics, and we'll be talking about her views and what's next. Welcome back to the show, Anna.
Hi, David. Very happy to be here.
Very happy to host you. Let's start by talking about first of all, your outlook for unemployment, and then we'll get into the details and we'll talk about some recent revisions from the BLS as well. What are you projecting the unemployment rate to do by the end of this year and perhaps into next year?
Yeah, so we have been of the view that unemployment rate will climb to 4.5% by the end of this year. And next year, it will continue to climb until hitting 5% and stabilize thereafter and falling from 5% only in 2026. And I would say 6 months ago, this view was the most bearish among surveys of forecasters on Wall Street. But recently, I just checked the forecaster log, and I see that 28 of 52 forecasters now have their projected unemployment rate being 4.5%, at least that or higher at the end of this year. So I would say 4.5% or even 4.5% unemployment rate is a kind of like consensus now in terms of where the labor market is heading to.
Before we get into details of what you just said, I've been hearing conflicting reports on what's causing this rise in unemployment that the economy has seen over the last couple of months. On the more bullish side, the more bullish camp, I've been told that part of this is due to the fact that the labor market is just expanding, partly due to immigration. And so naturally, you're going to get, with a larger labor force, you're going to get higher unemployment. It's not because layoffs are materially up. Can you comment on that?
Yeah, so I think the benign explanations for the rise in unemployment rate. So the unemployment rate has, before this August jobs report last Friday, has been rising for 4 consecutive months, each time surprising the consensus forecast by over 1 standard deviation. And that has happened for 4 consecutive months. And the benign explanation for this is, number one, as you said, David, it's due to immigration, and naturally immigration should push unemployment rate up while keeping GDP growth high. And the second reason to explain the July burst of unemployment to 4.4 was that it's just due to temporary layoffs related to Hurricane Beryl and also auto retooling in Michigan. So we could debunk both of these two myths. Number one, immigration, right? So it turns out that labor force expansion and an increase in labor force driving the unemployment rate higher is, in fact, often the case in the first half of all previous recessions. Particularly, I would say that the recession in 1974 is quite relevant to how to today's situation. In 1974, the baby boomers have become of age. They turned from teenagers to working age, and they started joining the labor force in droves. And that led to a very brisk expansion of labor force. And on top of that, you have, the women's rights. So a lot of women are also joining the labor force. And so in the beginning of the 1974 recession, the percent of layoffs that's driving the unemployment rate was quite low. It was only 40 to 50% of the unemployment rate increase then was only due to job losses. Fast forward to today, of the about 0.8% increase in unemployment rate since last year, slightly more than half is due to layoffs. And the other half is due to reentrants, new entrants. And this breakdown of the drivers of unemployment rate is in fact showing a higher percentage due to layoffs than the 1970s. And on top of that, what we are seeing is layoffs is actually picking up. So if you look at all these layoff notifications, they actually showed a quickening in the pace of layoff announcement in August and July. And July and August are not typically the months where firms announce layoffs. They usually announce in November, December, and January. So I thought the increase in layoffs recently, if the Fed is waiting for layoffs to happen before they want to cut rates, it's already too late. In all previous recessions, layoffs typically only happen well into a recession, probably second or third quarter into a recession. And I think with all the data we have now, I think the non-farm payrolls, once you adjust it for the overstatement of birth and death model factors and other overstatements issue, in fact, we have had negative payrolls in the last 3 months, starting in April.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. There's been a lot of chatter online about whether or not we should even trust BLS data at this point, given that we just had the biggest downward revision in non-farm payroll growth, revised down by 818,000. That was the biggest downward revision since 2009. And can you comment on this revision? I know revisions are part of the process, but a revision of this kind of scale and size, can you comment for the viewers what this means for data dependent consistency and reliability?
So BLS revisions is part of the process of how they deal with things. It's completely apolitical, has nothing to do with conspiracy theory whatsoever. However, it has everything to do with which point we in the business cycle. So usually at the turn of a business cycle, at the around downturns, the part of BLS forecasting process that starts to break down from reality is where as the part where they're forecasting how much jobs are added from new firms minus firms' bankruptcies. Because it's very hard to collect data on startups hiring or bankrupt firms because, as you can imagine, bankrupt firms won't be responding to BLS surveys. So these revisions reflect, and it's mainly driven by the fact that new firms formation in the economy has slowed significantly through 2023 and into 2024, and bankruptcies of firms has also surged coming into throughout 2023, coming into 2024. And if you think that the revisions is big for 2023, it will be even bigger for 2024. And those revisions will only be apparent in February of 2026. So, which is why if one wants to understand the true underlying pace of job growth in real time, you gotta be tracking the bankruptcies and new jobs formation data and adjusting the BLS estimate by what you think is overstatement due to firm birth and death.
Second quarter GDP, though, was revised upward to 3%, up from what was initially reported. So is that a conflicting indicator for you about, on the one hand, the GDP growing faster than what was initially reported, but on the other hand, revisions downward for the labor market, showing that the labor market is perhaps weaker than what was initially reported?
So, GDP gets revised over a matter of 10 years. In fact, the biggest revision would be a year later, and then there will be a comprehensive revision 5 years later. The revision schedule of GDP is even slower than non-farm payrolls. And both BEA and a Fed economist has done a study on the discrepancies between GDP and GDI. The GDI supposedly measure the same things as GDP, but from an income and profit perspective. So GDI was actually much weaker in Q1 and Q2 this year. They were running at 1.3%, which economists would call the stall speed, because once the economy falls, the growth falls below, like in the one-ish handle, is when it starts to the nonlinear animal spirits started going down. So these BEA and Fed papers suggest that in turning points, GDI also is a better leading indicator of the temperature of the economy than GDP, because the source data for GDI on the income and profit side actually comes from the QCEW data, which is precisely the benchmark data that drives these large non-farm payrolls revisions. So if you believe that the non-farm payrolls is going to see 818,000 downward revisions from April 2023 to March 2024, it means that the GDI data, the personal income data, is going to be revised down as well, because personal income is just number of workers multiplied by how many hours they work, minus, that's how they derive the personal income, right? So if you're adjusting down the number of workers, you're going to be revising down the income as well. And after you revise down the income, you will have a lower saving rate. So we saw last year, that the July's personal saving rate has fallen to 2.9%, which outside of this 2022, the pandemic window, the last time we see a personal saving rate that's as low as 2.9% was 2008. And just the reference to 2008 is kind of like, it caused you to give it a second look. Like, what does a low personal saving rate mean? And in fact, the true personal saving rate is probably lower because of these 818,000 downward revisions to non-farm payroll, which wouldn't be official until next year. So which means that the personal income data we are seeing right now is actually even potentially lower, and the saving rate's lower. But it will be only apparent next year. A low saving rate means that people are probably spending beyond their means now, and that the mark of resilience of a consumer is, if there is a negative shock, an adverse life shock in the future, are you able to sustain your pace of consumption? If your saving rate is so low, even when unemployment rate is at 4.2%, imagine what would consumption be if unemployment rate rises to 4.5%, 5%. It means that the sensitivity of consumption to a deterioration in the labor market would be much sharper in the absence of higher saving rates.
On the note of consumption, I'm just going to flip over to my screen here, and this is advanced retail sales, and I'd just like you to comment on this, please. If you show the chart as plotted by a percentage change from a year ago, it shows that it's still increasing in positive territory. In fact, the latest reading was positive 2.5%, which is a 2.5% growth in the previous year. And why is it that people are still spending more than a year ago, I guess, on a nominal basis, if it's indeed true that the personal savings rate, like you pointed out, is going down?
Yeah, so first of all, this is the nominal measure. So things are still expensive, and also they're spending as much because they are outspending their income growth. This is why saving rate is falling. And so when you see, a lot of commentary saying consumers are resilient because they saw this strong retail number, I think that is a misuse of the word resilient, because this is not because consumers are resilient that they're spending. They are spending because they're overspending. Resiliency means if unemployment rate were to rise by another 0.5 percentage points, are there enough buffer in the household balance sheet to keep them spending at this pace, or all this overspending in the past year catch up to them in an economic downturn? And maybe this will reflect my pessimism about the median American consumer. I think the financial management of a median American consumer is not very strong, and they tend to spend until they are maxed out their credit cards or nobody will lend to them. And we are already seeing credit card delinquency rising, auto delinquency rising, and housing mortgage tends to be the last thing people go delinquent on because they need to live in houses. And even there, we're seeing mortgage delinquency rising. And this is only when the unemployment rate is at 4.2. So I think the situation definitely does not suggest that the consumer is resilient.
Well, let's talk about housing now, since you made a tweet about this recently. I just switched over to my screen now. You said construction payrolls should cool possibly sharply, about imminently. Our leading indicator leads by 7 months. It is about that time. And then you showed a chart showing the housing leading indicators for 10 construction job cuts. So in the orange line, housing permits, less construction trending down. And I guess what you're trying to illustrate is that the white line, which is payrolls and construction, should also trend down soon.
Correct, David. And the reason why the orange line is dropping so quickly is because there's actually a backlog of multifamily homes building that started during the pandemic, and it's all coming online now. And there's currently, in fact, too much inventory in multifamily homes in the South. We're seeing housing price in the South correcting. We're seeing a lot of pending home sales cancellations, and typically cancellations are a leading indicator of whether the housing market is turning as well. And the reason why we haven't yet seen the white line follow this orange line in this chart is there's a 7-month lag. And the sharpest decline in the orange line really, really began in April of this year. And so that would mean around November of this year, is when the white line should catch up. Another reason is because the birth and death model that I mentioned to you. So in the BLS release of the early preliminary benchmark, the 818 downward revisions, we saw that substantial amount of that is coming from the construction sector. So it could also be that the white line is temporarily propped up by these overstatement in the birth and death model.
I see. Well, are you expecting a lower Fed funds rate into next year to change this forecast at all? Meaning, would mortgage rates potentially follow a lower Fed funds rate? And if so, what would mortgage rates mean for housing starts, permits, construction, and so forth?
So I think that's the $1,000,000 question, David, isn't it? That is whether we all know a rate cut is coming in September. Will a 20, and it looks like after today's CPI report, it looks like it's going to be a 25 basis point cut, not a 50 basis point cut. Is 25 basis point enough to stabilize the housing sector and the economy? Or even if is the 50 basis point enough? So I think there are 3 possible scenarios to look at this. Let's talk about a scenario. I know,
Sure.
right? Me talking
Okay.
about benign, but I can think about benign.
Sure. All right.
So I think the most benign way of looking at this is we can see the current slowdown in the economy and the pickup in unemployment rate as just a temporary soft patch due to uncertainty about the election. We have seen a lot of commentaries and surveys attributing a delay to CapEx plan or a delay on the consumer side to make big ticket purchases because of election uncertainty. So it could mean that after November, then the election uncertainty is over, and there would be a V-shaped rebound because firms will have a clarity on how tax policies could evolve. So they would, also by November, the Fed would have cut interest rates already, and would signal a clearer path of the interest rate cuts. And so on the firm side, they would be more willing to invest. Um, and also, if Kamala Harris won, her housing plan could also, come January, if it's true she's giving everybody a 25,000 down payment, housing down payment, tax credit, that could, rejuvenate the housing sector immediately and kind of like soak up the excess housing supply in the South. So that would be a benign scenario. That is, if everything is really due to election uncertainty, and in fact the Fed rate cuts would stabilize the financial. If the soft patch is just due to service level kind of vulnerability, maybe long-term rates are too high over the last 3 months, and the moment the Fed start cutting, long-term rates go down, housing sector bounce back, and economy bounce back, V-shaped recovery in that case. The second scenario would be the economy not yet in a recession yet, but is going to be in a recession because the Fed is too late in cutting interest rates. And I think the third scenario is that we are already in a recession for several months now, and the Fed is really, really late. And on top of that, there's election uncertainty, which is making what could have been a mild recession into a deep recession. I think I would put, in terms of subjective probability, on the benign scenario, I would put maybe 35% on the benign scenario. The second one, where we are about to tip into recession, we are not in one yet, I would put that as maybe 20%. So that's 20 plus 30. So I would say the last scenario where we are already in the recession, I think that's my dominant probability. And the reason why is I just think that when you put all the indicators in the economy together, how do you square the circle of rising productivity, GDI being low, firms reporting that the profits is falling, and the SOM rule triggering, and unemployment rate following a nonlinear trajectory in the past 4 months. Usually, I would interpret the productivity increase as a phenomenon of a late recession. It's like second half of the recession kind of thing, where firms already have laid off people, and as a result, productivity increase. It has a cyclical feel to it rather than a structural feel to it. And also, with our work on the revisions of the non-farm payroll, we thought that non-farm payroll was already negative starting in April, and it was actually very close to negative in October of last year. And ultimately, if the unemployment rate does rise to 5%, then even with the Fed rate cuts, because the Fed would be cutting too late in that scenario, it would also mean that the labor market has already sustained this nonlinear downward spiral kind of dynamics, which historically the Fed has not been able to stem. And particularly, they're so late in this cycle, and we're seeing personal saving rates of consumers dipping into 2008 levels, suggesting lack of resilience to future shocks. It could mean that the later and slower the Fed moves, this recession which could have been mild, would become deeper and deeper.
Well, you and I can talk a little bit more about election and campaign policies closer to the election date. But generally, I just want to know now, would your assumptions for the labor market and economic growth change depending on who wins the election in November?
I think it will. So I think in both cases, depending Harris or is it Harris or Trump victory, you will basically have 50% of the population thinking the world is about to end.
Okay. All right.
um,
That's fair.
so in terms of this is why when I put my subjective probability of the benign scenario of uncertainty resolving, and then like you can see a V-shape recovery, I think that's not my dominant scenario, just because half of the country think the world will end regardless. And then it gets to the actual policies themselves. And generally, I think that the market thinks that Trump's policy would be more friendly to businesses, lowering tax rates, extending picture. That should also boost income growth, and that should boost firm investment. On the other hand, Trump's tariff policy would be bad for investment, so that basically offset the positive investment impulse from extending picture, right, and lowering corporate tax rates. On the other hand, Harris' policy would be good for spending. Because she aims to put money in the hands of middle to lower income class. And these folks have higher marginal propensity to consume. And we have already seen what happens when you hand out checks to people in the lower and middle income class, which is they immediately spend it. You spend it on autos, you spend it on electronics. We saw that happen. I think it could be inflationary if it's in combination with more elevated geopolitical shocks, which we are having right now. I mean, the Red Seas and all these ships diverting from the Red Sea, and we already see some of that. So I think generally, in my view, the Harris policies might be somewhat more inflationary than the Trump policies. However, the Trump policies would be also probably be growth contractionary, not very favorable for growth. In that sense,
Harris's would be more inflationary than Trump's, even though Trump wants to implement tariffs, which some people say is inflationary.
Yes. So my view on that differs than the consensus. I don't think the Trump tariffs would be as inflationary as everybody thinks it is, and there's two reasons. One, using economic reasoning, and number two, looking at the Trump first administration and the impact of those tariffs. Let me talk about the second reason first. So lots of serious academic research has come out since the first Trump administration to look at the impact on GDP impact, inflation impact of those tariffs. And basically the consensus of academic research is that number one, U.S. importers did bear the brunt of the tariffs. However, the U.S. importers were only able to partially pass through those increased tariff costs to wholesaler. And wholesaler, however, were unable to pass through the increase in tariff costs to the retailer because the wholesaler has no pricing power. And so by the time, that's why the first Trump tariffs never really show up in the CPI, because basically inflation expectations were anchored. Firms have no pricing power, and so they just have to eat it through profit decrease. Because, think about it, economically, an adjustment to an increased input cost can happen through price or quantities. And in an environment like during the pandemic, when firms have pricing power because demand was very strong in the U.S., firms happily pass on the higher costs to consumers because that inflation environment is not very stable. But now we are in this environment where, as I mentioned, consumers are no longer resilient. They're tapped out. 80% are tapped out. Firms are losing pricing power. So if there's another input cost increase via tariffs, it would be the profit margins of the firms that would be hit, not the consumer's pocket. And ultimately, of course, the consumers would be affected because the firms are earning less profit, they'll be hiring less, there will be more layoffs, and so on and so forth. And David, just so you know, we already have a very clear evidence of this right now. So we have seen freight rate so container rates from Shanghai to U.S. rising sharply since middle of last year, and to a level almost as high as the peak in the pandemic. However, there has been no pass-through of that higher freight rate onto core CPI goods. Why is it? Well, because precisely consumers are tapped out. They could not pass through the higher cost to consumers. They are taking it through a hit on profits.
So bottom line, then your base case scenario for CPI inflation. Can you give us some color on that?
Yeah, so I think CPI, our baseline is that we will be seeing housing rents driving disinflation from here on to middle of next year. We see some more legs to the core goods disinflation for the reason that I mentioned. It's because consumers are pulling back. Firms have too much inventory still, and so they have incentive to lower prices to clear the inventories. That said, I also see some upward inflationary forces through auto insurance, home insurance, and also medical healthcare. Medical services prices have been artificially kept low in the past year or two because of a federal aid policy during the pandemic, and that's expiring later this year. So we are expecting Medicare prices to be reset to a higher rate next year. And that has a huge weight in the core PCE deflator, even a higher rate than housing rents.
Finally, I'd like to close off on the dollar, Anna. So I'm hearing two arguments here. On the one hand, a Fed cut may be bearish for the dollar, but on the other hand, if other central banks are also cutting, well, perhaps even at a faster rate than the Fed, that could put strength on the dollar relative to other currencies, would it not? Where do you stand?
Yeah, so the Fed so far has been the latest among G10, G7 countries to cut. It means that the pace, if our economic projections for unemployment rate is correct, and if the current bond market is correct, because the bond market is pricing a very sharp pace of rate cuts, they still think the Fed will have to do a jumbo cut this year. So if the bonds market is correct, then I think that overall we would be cutting at a faster rate than other countries. And that would be a net depreciating force for the dollar. Particularly, the Bank of Japan is also planning a hike this year. Yesterday, during the presidential debate, what's also happening was that a Bank of Japan official was talking about how they plan to hike rates this year. So I think that, the gap between the OJ and the Japan, that would drive a lot of the, currency relative movements.
Donald Trump has said that he wants a strong dollar. In theory, how would the government, not the Federal Reserve, but how would the White House implement such a policy?
Thank you for asking me that, because when I was working in the CEA at the White House in the first Trump administration, I was asked that question directly several times.
All right. Is your answer now different than the answer before?
No, I would answer in the same way. I mean, I think from the government perspective, they're looking for a pot of money that could achieve this. But the dollar and the treasury market is one of the most liquid market. And if the Treasury does have the Exchange Stabilization Fund, and it is kind of like it is kind of, you can think about it as the reserves. Other countries have foreign exchange reserves, right? So the U.S. also has this Exchange Stabilization Fund, which came from a history of back in the days of gold standard. You need this reserve, and so there's this pot of money, but it is not enough. I want to say it's about it's less than 100 billion. I haven't looked at it for a while, but it's around, three-figure billions, which is low three figures billion, which is nowhere enough to make a dent on intervention. Furthermore, all the literature, academics literature on the effectiveness of official FX intervention has been inconclusive. Particularly, many people have said that sterilized intervention will not work. Only unsterilized intervention will work for a little while. If it's an unsterilized intervention, then it means that the U.S. government will be putting money out there. Essentially, this is Treasury would be ordering this intervention. It would be almost the executive branch of the government affecting monetary policy through changing the money supply, and it's not great.
Okay. I guess there may be an indirect way to do this. Suppose we bring manufacturing back to the U.S. As Donald Trump has promised to do on the campaign trail. That may put more demand on U.S. made goods, hypothetically, and thus more demand on the dollar.
That would take a long, long time because the CHIPS Act was meant to jumpstart create these semiconductor factories in the country. Well, it is running behind schedule. The government is not the most efficient at building factories. So I would say this is really a third order kind of effect. Really, what drives the dollar from year to year would be interest rate differentials between countries and also growth differentials between countries.
We'll talk more about the dollar and the election in a few months. Fascinating talk. I wanted to focus on the labor market today. So thank you very much, Anna. Where can we learn more from you and read your work?
You can go on if you have a Bloomberg terminal, then you can go on BECO, BECO, Go, and you can subscribe to the U.S. team writings where we will provide our reactions and our insights, previews of data releases, or you can follow me on Twitter, and my handle is Anna Economist.
Okay, we'll put the links down below. So make sure to follow Anna there on Twitter, X, should I say. Thank you very much, Anna. We'll speak again soon. Appreciate your time.
Okay.
Thank you.